A powerful mechanism is moving capital right now, and most people do not see it because they are looking in the wrong place. They are looking at the same famous companies, the same headlines, the same index, and the same stories that everyone else is repeating. Meanwhile, money is quietly leaving the crowded places and moving into parts of the market that many individual investors have never studied seriously. That is how cycles usually work. The crowd notices the old move, the institutions prepare for the next one. By the time the story becomes obvious, the easy money has often already been made. If you miss this rotation, you may spend the next year watching the major index move sideways while a smaller group of stocks moves much faster beneath the surface. That is a very frustrating experience because it feels as if nothing is happening when in fact something very important is happening. The money is not disappearing, it is rotating. If you learn to recognize that rotation, you do not need to gamble on meme stocks. You do not need to chase whatever is fashionable that week. You give yourself a better chance to understand where the probability is improving and where the risk is being mispriced. That is the principle I want you to understand. The question is not simply, what stock should I buy? That is usually the wrong question. The better question is, where is money moving? Why is it moving there? And which companies are positioned to benefit if that movement continues? When I look at markets, I do not begin with a ticker symbol. I begin with the environment. I begin with the system. I ask what kind of world we are in, what incentives are changing, what pressures are building, and what capital is likely to do in response. The market is not a single thing. It is a machine made of many parts. Capital flows through that machine like water. It goes where it is rewarded. It leaves where the reward no longer justifies the risk. It often moves slowly at first, then suddenly, because human beings tend to notice changes late. That is why understanding the structure matters more than reacting to the headline. Right now, many people still think the game is simple. Buy the index, watch the biggest stocks, wait for the same leaders to keep leading. That worked very well in the previous phase of the cycle. But every cycle eventually changes. In one kind of environment, almost everything rises together. In another kind of environment, what you own matters much more than when you own it. We are no longer in the world where every speculative asset rises because liquidity is abundant, rates are near zero, and everyone is rewarded for taking risk. That was a different weather system. I think about markets a lot like weather. You do not have to predict every raindrop. You do not have to know exactly when the wind will turn. But you do need to know whether you are in sunshine, clouds, or a storm. If the weather changes and you keep wearing the same clothes, you will eventually suffer. Investing works in a similar way. Your job is not to predict the future perfectly. That is impossible. Your job is to look clearly at the conditions that exist now and position yourself in a way that fits those conditions. So what is the weather right now? Inflation risk has not disappeared. Interest rates may not fall as quickly as many people want them to fall. Governments are still under pressure to spend. Central banks are still trying to manage a difficult balance. Geopolitical tensions are real. Energy security matters. Supply chains matter. Defense spending matters. Minerals matter. Data centers matter. Power matters. This is not 2021 and 2021. Many people felt brilliant because nearly everything went up. That is one of the most dangerous lessons a market can teach, because it trains people to believe that luck is skill and liquidity is judgment. But when the environment changes, that illusion breaks. In a different environment, the market becomes more selective. Some sectors receive capital, others lose capital. Some industries gain powerful tailwinds, others become heavy because the old story has already been priced in. That is why the important question is not whether the market is up or down today. The important question is which part of the market is absorbing capital and which part is releasing it. Most people do not think this way. They look at the index and they assume the index is the market. It is not. The index is a structure. And if you do not understand that structure, you may think you are diversified when you are actually very concentrated. Take the S&P 500. Most people know it as an index of large American companies. What many people do not fully internalize is that it is weighted by market capitalization. The bigger a company becomes, the more influence it has inside the index. The more money flows into index funds, the more money is automatically directed toward the largest companies. That creates a feedback loop. The biggest companies receive more passive inflows because they are already big. Those inflows can help them get bigger. As they get bigger, they become an even larger part of the index. Then even more passive money is sent their way. It is a flywheel. Flywheels can be powerful. They can also be dangerous if people forget that they are flywheels. If one very large company is many times larger than another company in the same index, every new dollar that goes into that index buys far more of the large company than the smaller one. That is not a moral statement. It is just how the structure works. Because passive investing has become so large, this structure matters more than many people realize. Pension money, retirement money, 401k money, ETF money, and automatic savings all flow through these systems that creates consistent demand for the largest companies. Right now, a small number of companies represent an unusually large share of the index. When the largest companies are working, that feels wonderful. Your index fund rises and it appears that diversification is doing its job. But when those companies stop leading, the same structure that helped you can hold you back. You may own 500 companies in theory, but in practice, a large portion of your result depends on a very small group of giants. That does not mean index investing is bad. It means you must understand what you actually own. One of the biggest mistakes investors make is believing that simple products eliminate complexity. They do not. They package complexity into something that looks simple. If the largest technology and mega cap companies keep going up, the index can look strong. If they stall, the index can look tired even while other areas of the market are starting to work beneath the surface. That is when sector rotation becomes important. The educated money does not sit still forever. It moves from crowded areas to less crowded areas. It moves from expensive assets to cheaper assets. It moves from sectors where expectations are already very high to sectors where expectations are still low, but conditions are improving. This is not because institutional investors are magical. They make mistakes too. But they are trained to look at markets as flows, not just stories. They ask where capital is going. They ask where supply and demand are changing. They ask where the macro environment creates a tailwind, and they ask where the leading companies inside those areas are beginning to show that the money is arriving. That is the framework. I start with the environment. I want a clear weather report. I do not need a PhD level forecast. I need to know the broad conditions. Is inflation pressure still relevant? Is energy scarce? Are critical minerals becoming strategically important? Are governments spending more on domestic supply chains? Is geopolitical risk changing how countries think about infrastructure? Then I look at sectors. I ask which sectors are beginning to fill with capital. I do not want to choose randomly. I want to rank opportunities based on where the money appears to be moving. Only after that do I look at individual companies. Many investors do this backward. They start with a stock tip, then they look for reasons to justify it. That is a bad process. A better process is to begin with the world, move to the sector, then look for the strongest companies or the most interesting setups within the sector. That sequence matters. If you start with the company, you can fall in love with the story. If you start with the environment and the flows, you are more likely to think in probabilities. The first area I am watching is connected to energy infrastructure, especially the picks and shovels of oil and gas. During a gold rush, the people who make the most durable money are not always the miners. Often they are the people selling the tools, building the roads, providing the equipment, and maintaining the system that everyone else needs in order to operate. Oil and gas have a similar structure. There are producers that drill and sell energy, but there are also companies that provide the equipment, machinery, services, compressors, drilling tools, pipelines, and infrastructure that make energy production possible. Those are the picks and shovels. When the world needs more energy, those companies can benefit. When energy security becomes a national priority, those companies can benefit. When liquefied natural gas infrastructure has to be built, those companies can benefit. When supply routes become unstable and countries want more domestic capacity, storage, terminals, pipelines, and drilling support, those companies can benefit. The point is not that every company in the sector is automatically attractive. That would be careless. The point is that the environment is creating reasons for capital to look at this area. Again, AI is not just a software story. It is also an energy story. Data centers require enormous amounts of power. The more the world digitizes, automates, and computes, the more the physical system behind that computation matters. Power plants matter, natural gas matters, LNG matters, infrastructure matters, equipment matters. At the same time, geopolitics has made energy security more important. When key shipping routes or choke points become unstable, countries and companies do not simply hope the problem goes away. They plan for redundancy, they build storage, they consider new pipelines, they invest in domestic or safer supply. All of that can send money toward energy machinery and services. One company in this area that I would watch is Baker Hughes, ticker BKR. This is a major oilfield services and energy technology company. In simple language, it is part of the picks and shovel system for oil and gas. It helps support the infrastructure that allows energy to be found, produced, transported, and processed. What I like about a company like this is that the story is not just a simple bet on oil going up tomorrow. It is connected to larger capital spending, energy security, LNG build-out, And the equipment cycle, that is a more durable way to think. If the world needs more energy infrastructure, companies that help build and maintain that infrastructure can become important. If geopolitical pressure creates more urgency around supply, that can reinforce the trend. If LNG demand continues to grow, terminals and equipment become more important. This is the kind of company I want to study when I see money moving into energy services. But I would not buy it simply because the story sounds good. Stories are not enough. I want to see the market confirm that capital is actually coming in. I want to see the stock move through prior resistance. I want to see volume. I want to see whether institutions appear to be accumulating. I want to see whether the price action is consistent with the thesis. That is where many investors get uncomfortable because they have been taught that buying lower is always smarter than buying higher. It is not that simple. Sometimes a slightly higher price can carry better information. If a stock has been moving sideways and then breaks above a prior high, that may show that demand is finally strong enough to absorb supply. It does not guarantee success, nothing does, but it can improve the odds. Wall Street often prefers confirmation over cheapness because price contains information. If something is cheap but keeps getting cheaper, cheapness is not helping you. If something breaks out of a base after money begins to rotate into the sector, that may tell you the probabilities have changed. This is not a stock tip, it is a process. Another name in the same broad energy infrastructure world is NPK. This is a smaller company involved in temporary worksite infrastructure for energy and construction projects. Smaller companies can move more sharply, but they can also carry more risk. That is why process matters even more. What makes a name like this interesting is not simply that it has already moved. It is that it sits in a part of the economy where capital spending, energy projects, construction, and infrastructure may continue to matter. If the stock has moved sideways after a strong advance, I would look for whether it can break out of that consolidation. I want to see whether the prior highs can be exceeded. I want to see if the market is telling me that buyers are willing to pay up. Again, many people hear that and think it sounds irrational. Why would you want to pay a little more? Because you are not paying more for the same information. You may be paying more after the market has given you better information. That distinction is very important. A low price by itself is not a margin of safety if the trend is broken. The sector is weak or the thesis is not supported by money flow. A higher price after confirmation may sometimes be a better expression of risk management than a lower price before confirmation. The goal is not to be clever. The goal is to stack probabilities. Stocks often move in waves. They rise, pause, consolidate, and then either continue or fail. When a stock goes sideways for a period of time, it can be building energy. If it then breaks above the range with strong demand, that can be meaningful. That is what I watch. I do not need to predict every move. I need a process that tells me when the odds are improving and when I should step aside. The second major area I am watching is critical minerals and related mining. At first, it sounds less exciting than technology. That is exactly why it can become interesting. The world is becoming more electric. Electric vehicles require lithium and other materials. Batteries require minerals. Renewable energy requires storage. Storage requires materials. Power grids require upgrades. Data centers require power and cooling. Defense systems require secure supply chains. Governments do not want to depend entirely on foreign countries for strategic minerals. When you put those pieces together, the picture becomes clearer. This is not just a commodity story. It is a strategic supply story. Countries are learning that the physical inputs of modern life matter. You cannot build the energy transition, modern defense systems, advanced computing, and domestic supply chains with slogans. You need materials, you need mines, you need processing, you need infrastructure, you need financing. That is why government support matters here. When governments begin mobilizing capital to develop domestic mineral supply chains, that can change the environment for companies in the sector. It does not remove risk. Mining is risky. Commodity prices are volatile. Projects take time. Politics can interfere. Balance sheets matter. But the direction of strategic demand is important. One company in this area is SQM, Sociedad Química y Minera de Chile. It is one of the major lithium producers in the world. Lithium connects directly to batteries, electric vehicles, and energy storage. The company has operations and growth initiatives tied to important lithium supply regions. Again, the key is not to hear the word lithium and immediately buy something. That is not investing, that is reacting. The key is to ask whether the sector is receiving money, whether the company is a leader, whether the stock has formed a structure that improves the risk-reward, and whether price action confirms that the market agrees. If a stock has been moving sideways and begins to break out of that range, I pay attention. I would rather see confirmation than simply buy because the narrative sounds powerful. This is especially important in commodities because narratives can be very seductive. Everyone can tell a good story about future demand. But if supply comes faster than expected, or if prices fall, or if capital leaves the sector, the stock can still perform badly. So I want the story and the flow to line up. Another company I would watch is UEC, Uranium Energy Corp. Uranium sits at the intersection of energy security, nuclear power, and the need for reliable electricity. If AI data centers require more power, and if countries want more stable power sources, nuclear becomes part of the discussion again. There is also a domestic supply angle. If a government wants uranium supply that is less dependent on geopolitical rivals, domestic production capacity becomes more important. UEC has been connected to new uranium production in the United States, including operations in places like Texas and Wyoming. That matters because production capacity is not just a financial detail, it is part of the broader question of energy security. But here again, I would be careful. A stock can have an excellent long-term theme and still be too early. If the price has rallied, collapsed, and then started forming higher lows, that is interesting, but it may not yet be enough. I want to see the reversal become clearer. I want to see the market prove that buyers are taking control. Being early can feel smart, but it can also be expensive. One of the principles I have learned is that it is often better to be a little late and right than very early and stuck. If a stock is still sleeping, I can keep it on a watch list. I do not need to force the trade. I can wait for the setup to improve. That is discipline. A third mineral. Related name is CMP, Compass Minerals. This is another way to think about minerals, rare earth exposure, and materials that can benefit if the world continues to focus on domestic supply, energy systems, and industrial inputs. What matters in a name like this is whether it is close to breaking out of an important range. If the price needs to rise further before the setup becomes interesting, I am willing to wait. Most people hate waiting. They want action, they want certainty, they want the feeling that they are doing something, but investing is often about preparing before action is required. You build the watch list before the breakout, you understand the thesis before the move, the levels before the emotion arrives. Then, if the market confirms, you can act with a plan instead of reacting with panic or excitement. That is the difference between process and impulse. The broader lesson is that money moves between sectors all the time. Think of the market as a chessboard. One square may be software, another may be oil and gas services, another may be uranium, another may be critical minerals, another may be healthcare, defense, insurance, electronic components, or construction. Capital does not sit evenly across the board. It moves. When money leaves one square and enters another, prices respond. It may not happen instantly, it may not happen cleanly, but over time, flows matter. The mistake is believing that the market is one big object that simply goes up or down each day. That is the way financial media often describes it because it is easy to explain. But it is not the way capital actually behaves. Capital rotates. When the S&P 500 is flat, some industries may be breaking out. When the index looks weak, certain sectors may be attracting money. When the famous stocks are resting, the less famous stocks may be starting their move. If you only look at the index and the same mega-cap names, you may miss the important rotation. That is why I use a sector. First process, I want to know the weather. I want to know where the money is flowing. Then I want to know which leaders or setups inside those areas deserve attention. This process can work in bull markets, sideways markets, and difficult markets because it is not based on one prediction. It is based on observation and adaptation. If money keeps flowing into a sector, I can stay interested. If money leaves, I change my view. I do not need to marry a position. I do not need to defend a story after the evidence changes. That is an important principle. Your job is not to be loyal to a stock. Your job is to be loyal to reality. Now, none of this works without risk management. A strong theme can still lose money. A good company can still fall. A breakout can fail. A geopolitical thesis can change. A commodity cycle can reverse. A government policy can disappoint. A stock can do exactly the opposite of what you expect. That is why position sizing matters. I would never want one idea to have the power to seriously damage my financial life. I want the risk of any single position to be small enough that I can think clearly. For me, the key is defining the loss I am willing to take before I enter. A position may be larger than 1% of a portfolio, but the risk on that position can be managed so that the potential loss is limited. The specific number depends on the person, the portfolio, and the strategy. The principle is what matters. Do not confuse excitement with conviction. Do not confuse a good story with a good trade. Do not confuse a sector tailwind with immunity from loss. And do not put a large amount of money into something you do not understand simply because someone made the case sound persuasive. You can build positions gradually. You can use individual stocks if you understand them. You can use funds if that fits your ability and risk tolerance better. You can keep names on a watch list and wait. The important thing is to have a system. Most people spend enormous time earning money and very little time learning how to manage it. That is one reason they stay reactive. They work hard, then hand their financial future to slogans, headlines, or whatever the market is doing that week. That is not a principle-based way to operate. If you can spend even a small amount of time each week understanding the environment, watching sector flows, and studying the leaders in the strongest areas, you can begin to see the market differently. You stop asking, what is everyone excited about today? You start asking, where is capital moving before the excitement becomes obvious? That one shift can change the way you invest in the current environment. The two areas I would watch carefully are energy infrastructure and critical minerals. The specific names that belong on the watch list include Baker Hughes, NPK, SQM, UEC, and CMP. Each has a different risk profile. Each needs its own analysis. Each should be judged by both the underlying thesis and the market. Confirmation. The reason these areas matter is simple. The world is becoming more energy intensive, not less. AI requires power. Electrification requires minerals. Supply chains require security. Governments are realizing that strategic inputs cannot be an afterthought. Geopolitical risk is forcing countries and companies to rethink infrastructure, storage, domestic capacity, and redundancy. Those are not small forces. They are structural forces, but structural forces do not remove the need for timing, risk control, and discipline. They simply tell you where to look. That is the whole point. Do not chase blindly. Do not buy because someone gave you a ticker. Do not assume the index tells the whole story. Do not believe that the largest companies will dominate every phase of every cycle. Look at the machine, look at the flows, look at the sectors, look at the leaders. Then wait for the market to confirm. If the confirmation comes, act with a plan. If it does not come, do nothing. Doing nothing is often the most underrated decision in investing. The market rewards patience, but only when patience is combined with preparation. If you are not prepared, patience becomes passivity. If you are prepared, patience becomes an advantage. That is how I think about this moment. A quiet rotation is underway. Most people will not see it until the headlines explain it. After the move has already happened, they will keep watching the same few giants. They will keep wondering why the index is not giving them the result they expected. They will keep thinking nothing is happening, but beneath the surface, money is moving. And in markets, following the money is often more useful than following the noise. The rich do not become richer because they always predict the future perfectly. They become richer because they understand systems, incentives, flows, and risk. They know when a structure favors them. They know when concentration becomes dangerous. They know when capital is rotating. And they know that the market is not one simple object moving in one simple direction. It is a living system. When the system changes, your process must change with it. That is why I would rather study sector rotation than argue with the index. I would rather understand where the money is going than debate whether the market is good or bad. I would rather identify the areas receiving capital than react to yesterday's headline. The opportunity is not in pretending to know everything. The opportunity is in seeing enough of the pattern early enough to act responsibly. That is what I mean by following the money. Not chasing, not gambling, not believing that one stock will save you. Following the money means understanding the environment, identifying the sectors gaining strength, studying the strongest companies inside them, waiting for confirmation, and protecting yourself if you are wrong. That is a real investment process, and in a market where the index can be dominated by a handful of giants, where passive flows can make concentration look like diversification, and where capital can rotate quietly beneath the surface. Having a process matters more than ever because the next big move may not come from the place everyone is staring at. It may come from the place most people never bothered to look.